Well, you have to go back to mid-2007 to a time where most economists were as wrong-footed on an interest rate decision. Joining me to discuss why the Reserve Bank chose to leave rates on hold and just what the government can do to deliver its much-promised budget surplus by 2012-13, I'm joined by Nigel Stapledon, Associate Head of Economics at the Australian School of Business, University of New South Wales, and Paul Brennan, who's Head of Market Economics at Citigroup. Gentlemen, welcome to Lateline Business.
Thank you.
Evening.
Well, Nigel Stapledon, you must be very pleased that you're no longer doing much forecasting.
That's right. It's a very hazardous business. You can look a fool many times.
What do you think was the main driver behind the RBA putting rates on hold?
Look, I think it's, in a sense, just a stay of execution here. The base case they're putting is that we're going to see very strong private demand over the next 12 months, particularly from business investment linked to sort of resources boom Mark II. But sort of on the consumer side, maybe there's a little bit of hesitancy in terms of credit growth, sort of interest rate rises in the past, sort of showing a bit of hesitancy there. So they think that's sort of buying themselves a bit of time. But that's essentially all it's doing.
Paul Brennan, you were one of the many economists who went the other way. Do you agree with Nigel, and were there other issues like the dollar and Europe?
Yes, I agree with Nigel. I think looking at it, earlier in the month we had the sharp fall in the unemployment rate from 5.3 to 5.1%, and then there were some smoke signals, if you like, coming out of Martin Place from the Reserve Bank that they were getting worried about what the strength in the economy might mean for inflation. And so the market sort of then went off and basically priced an interest rate rise. The dollar went up quite strongly on the back of that. But as the month went on, basically what we saw was a run of quite softer data, and I think one of the things that really stands out, two of the things that stand out from the Reserve Bank's point of view, is that there's a lack of leverage sort of driving growth at the moment in the economy. So you look at business credit, it's quite tame. If you look at the household sector, house prices have cooled off, so people aren't chasing higher house prices, and I think that made the Reserve Bank a little bit more comfortable. And then finally, I think they've probably started to reassess a little bit this narrative that next year the economy will be really steaming on the back of the next phase of the resources boom. Yes, it will happen, but it looks like some of these big projects, particularly the LNG projects and other mining projects, might come through a little bit later in the year rather than earlier.
Well, Nigel Stapledon, do you think that the words that Glenn Stevens used today, leaving things very open, he says it's likely that higher interest rates will be required. All eyes will be on those official CPI numbers, obviously, in 3 weeks' time. But do you think, as a betting man, there would be a big movement on Melbourne Cup Day?
Well, there's still a fair chance. I mean, he's broadcasting that our base case, or our 60% base case, is that the economy is going to be strong, and we're mostly going to see news which is going to swing what was probably a finely balanced decision today to a rate rise. So Melbourne Cup Day, why not? I mean, essentially, you know, they do see the economy being very strong, but they recognise it's only a forecast. And they can get forecasts wrong.
Well, I mentioned that the May 2007, the last time the market was wrong-footed, and then, of course, we had inflation take off, and the Reserve Bank had to come down pretty hard. The cash rate was 6 3/4 by November, 7 1/4 by March. Do you think, Nigel, that there's any danger that the Reserve Bank might make the same mistake?
Look, the Reserve Bank is very cognizant that back then they got wrong-footed by a few attractive inflation numbers, and they really should have moved harder and earlier than they did, and then inflation did take off.
Paul Brennan, do you agree with that there will be a rise before the end of the year?
We do. But I think the thing to watch, rather than inflation itself, I think maybe the focus will be more on the labour market, because, as Nigel said, I don't think they want to make that same mistake about waiting around for inflation figures. The labour market figures, we think, tend to be the most reliable gauge on the economy in terms of, timely indicator. And so we've seen the unemployment rate drop from 5.3 to 5.1. If the figures which come out later this week were to drop further, then I think the Reserve Bank would then raise rates again next month. But our central case is unemployment will probably stay stable for a couple of months, so we're sort of thinking that there'll be a rate rise just before the end of the year.
All right, well, I now want to turn to the big four banks. Nigel Stapledon, you used to work for Westpac. We all know that the banks have been itching to raise rates. They held off during the election campaign. How do you think they are going to play it? Are they going to hide behind a Melbourne Cup rise, do you think, and raise rates higher?
Well, last time Westpac went first, which was my old bank, and of course they copped a lot of political flack and a lot of bad press from that. So, you know, the banks do face that sort of political pressure the other way. But on the other hand, cost of funds has been going up for the banks, so that is an issue for them. So as a shareholder, one has an interest in the banks putting it up. So, well, of course, Wayne Swan,
they will hide behind it. Wayne Swan has hit back, saying in the last few days that banks are making healthy profits. Their net interest margins are back above what they were before the global financial crisis. Do you think there is justification, Paul Brennan, to raise interest rates out of cycle?
Well, if the banks have been putting this case that their cost of funding's been going up, so if they really believe that, well, then they should go ahead and do that, regardless of the political pressure. The fact that they're sort of holding back a bit sort of almost makes you wonder whether the narrative or the story that the banks are spinning is perhaps maybe stretching it a little bit. And in fact, in the Reserve Bank's recent report, financial stability report, they indicated that lending margins had actually already risen to some extent. So, it really comes back to the banks. If they believe their own rhetoric, well, then rates will be going up fairly soon.
Well, let me move to fiscal policy now, and the government's still saying that it will move into continual surplus from 2012-13. The Red Book, which is given to government by the Finance Department, raises major concerns about whether the 2% cap that the government has on spending is actually enough. Nigel Stapledon, can I ask whether you agree with their concerns about the extra spending, $2.4 billion that the independents want, payoff on programmes like insulation, more money for the Murray-Darling? Is this going to be a big concern?
Well, I think the interesting thing that's come out of this is sort of estimates on the structural position, because while sort of 2 years out the government's talking in terms of an underlying cash surplus, what is revealed is, in fact, at the top of a terms of trade boom, the biggest boom Australia's had for, 50-odd years, we're probably going to have a structural deficit. So I think that's sort of what they're focusing on from a fiscal side, that if you take away the high commodity prices, then the fiscal position doesn't look that attractive. So, in fact, that's an argument for, if you want to improve the underlying fiscal position, you really need to work a little bit harder.
Paul Brennan, do you actually have faith that the government are going to maintain this surplus by 2012-13?
I think they'll be forced to. I don't think the markets would be very forgiving if the government didn't follow through with this promise. The government's made a lot of this promise. They've touted this around the world, and they touted this at the election. And so I think they've really got to follow through, because if as Nigel pointed out, that this is a time when the economy is growing strongly. There's a lot of potential revenue for the government over the next couple of years, and if even with the additional election promises, there's really no excuse that they don't deliver on this promise.
I should ask you both about a little bit of speculation that's gone on with the Red Book, in particular in relation to censorship and the blacking out of attachment G in this Red Book. Nigel Stapledon, what could be so market sensitive that I don't think even the opposition wants to reveal, because there's a similar section in the Blue Book that they've got as well?
Well, it's been speculated that there's reference to a housing bubble. Now, I mean, what governments never want to do, and the GFC was sort of like the exception, is they never want to forecast sort of real dangers down the track. I mean, they never really forecast recessions, because if the government forecasts it, then there's a it becomes self-fulfilling, or that's the perception. So,
but do you think it's a property bubble bursting or something else?
Well, I actually thought in the place where it was actually probably more reference to some of the external risks, because we're riding the China boom and perhaps...
so more of an international crisis. Paul Brennan, briefly, do you agree?
Well, it's a bit hard to tell because, as you point out, it's totally blacked out, and there's not a lot of guidance. But one of the areas that was blacked out, and you've got some idea, was on the climate change policies. And there's a whole series of paragraphs blocked out there, and I suspect that was a direct criticism of the opposition's policies to do with direct action measures. The Treasury view is very strongly that we need to set a price on carbon, and we need to use emissions trading scheme to do that.
All right, well, gentlemen, we shall go on speculating. Nigel Stapledon and Paul Brennan, thank you very much for joining us on Lateline Business.
Thank you.
Thank you.